I'm Greg Hunter. Welcome to USAWatchdog.com. You know, I've been following this coronavirus, the Wuhan virus, or just the Wuhan corona. And I'm watching Wall Street, and I'm watching the bad news, and I'm thinking, well, what is going on? For example, every day, bad news. And before I bring on the guests, let me read a couple of headlines. World Health Organization turns on China, demands to know, this is just out on Friday, demands to know how nearly 2,000 doctors were infected. Another headline, and this is on Zero Hedge, it's coming, a CDC director warns coronavirus to become widespread throughout the United States, probably beyond 2020. We had the World Health Organization guy out last week on Thursday. They're playing this on mainstream media, saying that we must do everything we can do to contain it now. He's actually freaking out. You can hear it. You can see him. And there will be an antidote for 18 months. China is shutting down. Air traffic is shutting down. China is demanding people open up their air traffic all around the world, and everybody is cutting them off. Listen, I don't know what the medical effects are of this, but the financial effects for a guy that doesn't manage 10 cents looks awful. And I've been thinking, Michael Pento. Hey, China has 40 trillion in debt. Michael Pento. As I said in my weekly news wrap-up, he's never wrong. So I thought I'm going to pull Mike. He had him booked for later, but I wanted to bring him on, now, because this is awful. So Michael Pento, Pento Portfolio Strategies, I caught him in the office. This is your early Sunday release, but I caught you in the office on a down day, and you're kind enough to come on in short notice and talk about this. Listen.
Thank you, Greg.
This is
Happy Valentine's Day, by the way. I wore red just for you.
This is awful.
Even though I didn't know I was going to come on, I wore red just for you.
I'm going to start with this question. Is this the blackest of black swans in the financial world? Forget about the medical world. Forget about the PR and the brutal stuff that China's doing, the totalitarian regime. Forget about persecuting. Forget about all that.
Yeah.
I'm just
how can you?
But the economic fall, that factories are shutting down. Everybody's cutting off China. Air traffic is shutting down.
By the way, they hired. Oh, just say this. They hired a guy from China to oversee Hong Kong, who was responsible for knocking down all the crosses on Christian churches. This is, when you say don't forget, we'll forget about it for now. But this is a very dangerous nation, China. Not the people of China, the government of China. And I don't believe anything. I don't believe any of their numbers. They're making up these numbers for deaths, the infections. But here's the thing I wanted. To tell you today. It is shocking to me that the stock market cares nothing. The global stock market cares almost nothing about this very virulent virus, a virus that is much worse than SARS or MERS was. And for a country that has $2 trillion in debt in 2020 and now $40 trillion in debt, the biggest amassing of debt the world has ever seen, and at the fastest pace, never before matched in history. This is a country teetering on meltdown. And then to have this virus on top of it, which, as you say, the ports are closing down. We have major multinational corporations in the United States saying, hey, we can't even give guidance throughout 2020. Nike, for one. Apple, for number two. Google. I mean, you have major U.S. corporations saying we can't even give accurate readings on what's going to happen in 2020. And yet Wall Street doesn't care. And it's because China and the United States and all the other central banks are printing money like never before, trying to mollify the effects of this virus. In fact, China alone, on February 3rd and on February 4th, 2 days, printed $250 billion and threw it at their banking system, the People's Bank of China, just to try to offset the effects of this virus, which, by the way, is going to bring about I'm predicting this, write it down, record it. We are going to have a global recession in Q1 2020. U.S. GDP is lucky if it even has a one handle, but Singapore is warning about a recession. Australia is warning about a recession. The Eurozone, which is barely growing at all, and I'll get into some of the numbers after I get you back in. The Eurozone, which is China's biggest customer, is going to be in a recession in Q1 2020. But nobody cares because the maniac money printers have gone mad.
The is this the? I said this on my wrap up that this is the blackest of black swans. Is this the blackest of black swans?
Okay, so you had me on a short notice, so you forgive me if I read. So let's just talk about SARS. The SARS virus, circa 2000, late 2002, early 2003, what was a small blip of a downturn in economic growth. And of course, Wall Street is embracing this fallacy with alacrity. But let's go through some numbers. So from November 2002 to July 2003, the SARS virus infected 8,098 people and killed 774. But from December 8th, 2019 through today, which is February 14, 2020, the coronavirus has infected over 63,000 people and killed 1,338 people. 1,383 people. I'm sorry.
If you believe their numbers.
That's by the way, if you believe the official figures from the People's Bank of China and the People's Government of China, which is known to, let's just say, let's put it kindly, obfuscate the truth.
So this is
much more virulent, much more deadly, and percentage-wise, it's not as deadly as SARS, but has already killed much more people in a much shorter period of time, and it's already appearing in the United States, in Europe. It's all over the planet over here, and it could become a global pandemic. But Wall Street just doesn't care. They just don't seem to care as long as they can keep the liquidity spigots going. However, I'm asking this. Can money printing solve a recession right away? I mean, didn't we prove in 2000 and in 2007? So in 2008, the Fed started lowering rates from 5.25 to 0 from late 2007 through the end of 2008. We still had a mini depression. So printing money doesn't solve all the problems. And like you said in your pre-interview, when goods stop showing up at the ports and shelves are empty, and then the algorithms on the trading algorithms on Wall Street start reading things like shelves empty in Walmart. Is that something going to be overlooked because Jerome Powell is going to keep the repo facility going? I don't think so. I really don't. But Wall Street right now, as for now, they just don't care. That's the challenge, by the way, in managing money. So I have a very complicated 20-point model. Lets me know when to panic. And you very well may need to panic. It's obviously not a condition to panic today. Here's the stat for you. There's $6 trillion worth of collateralized loan obligations, CLOs, and junk bonds. This is the biggest bubble in history. The junk bond market is going to be the nucleus of the next crisis. You're hearing that from somebody who went on record predicting the NASDAQ bubble and got it right almost to the day. Okay, I sold everything I had personally in March of 2000. I then was on television and was derided weekly throughout 2007 and throughout 2008 on the Kudlow program on CNBC, derided every day for warning about the collapse in Fannie and Freddie, the collapse in the housing market, and the collapse in the U.S. economy and in the global economy. So I'm not one who is very hard to spot bubbles. The bubble today is in the fixed income market, and in particular, junk bonds. And junk bonds the prices are rallying. Yields are falling, even though they're the tightest spread to treasuries we have ever seen, and the nominal yields are the lowest in history. Why would the junk bond market be rallying into the manifestation of a global recession? Now, you can even tell me, this is going to be temporary. They're going to solve the problem in the matter of quarters, and there'll be a vaccine for next year. I mean, maybe all that's going to be true. But Greg, the earnings growth for all of last year on the S&P 500 was zero. Earnings growth, S&P 500, 2019 was zero. And the reason why the stock market is at an all-time record high now, an all-time record high valuation, that is not disputable. And even Charlie Munger, okay, of Berkshire Hathaway, okay, Warren Buffett, Charlie Munger is man. He says that, and I'm paraphrasing, this is the most incredulous state of denial I've ever seen the stock market in. And this gentleman, I think he's in his 90s or late 80s. He's an old man. He's been around a long time, a lot longer than me. He can't even believe it. And he's not prone to hyperbole, and neither am I. But the Wall Street trading algorithms and the robots have just been programmed to ignore everything because this is going to go away, don't you know, in the next couple of weeks. But if we start seeing this virus manifest itself in other countries, and then we start closing down other borders, like the border between Canada and the United States, then you're going to see the robots turn the other way, and this market's going to crash. And like you said, it could be a black swan event. You have to be an active manager. You have to be able to model it and profit from it. Don't be a buy and hold, passively managed pigeon. This is not the time to do that.
I kind of think the black swan has already busted out the windshield, and Wall Street's acting like a mosquito hit the windshield.
So let's just go back to China in 2003. So China was a much stronger nation in 2003. It was growing at 11%. Today, if you believe the numbers, it's growing at half that. But let me just read something to you. China is a much bigger part of the global economy today than it was in 2003. As a share of GDP in 2003, China was 9%. Today, it's 21% of global GDP. And these empty cities, they have their empty cities that were just built because of a massive overbuild in infrastructure and fixed asset investment.
Yep.
But now even the cities that were occupied are empty. They brought a lot of factory workers back to work on Monday, February 10th, and 10% of the employees showed up. You're taking a country with $40 trillion of destabilizing debt, as David Stockman calls it, the red Ponzi scheme. I couldn't agree with him more. And then you're taking a country that's already decelerating growth rapidly from where they were just in 2003, just maybe a few years ago. The stock market is already cut in half. And then you throw into this the coronavirus, which has virtually shut down the entire nation, which is the second biggest economy on planet Earth. And Wall Street doesn't care.
This has no sign of all the headlines that I read as a reporter. All the headlines seem worse and worse and worse. And even the headlines are, we might have a vaccine. The World Health Organization came out last week and said, stop it. No, stop that. Mm-hmm. We're not going to have it for 18 months.
They're not going to mass produce and disseminate a vaccine
in a month.
In a month. There's no way that's going to get approved. Certainly not in the United States. So
they got this 40 trillion. I want to go back to this 40 trillion in debt you talk about. How in the world can they service 40 trillion in debt if their factories are shut down, everybody's closing their borders, closing air flights? How can they already have a force majeure on certain oil and natural gas imports because they're not using them? So in other words, sorry, we defaulted.
Yeah.
What's going to happen to this $40 trillion in debt if this keeps going?
Okay, so the only way naturally you should be able to service debt is through your tax base. So if people aren't working and they're not getting paychecks, then your tax base goes away. But Jerome Powell said something, and you'll let me a little latitude. I'll make the nexus between Powell and what's going on in China. Jerome Powell said something in his Humphrey Hawkins testimony, or it used to be called Humphrey Hawkins testimony, before Congress this week. You know what he said? He said, and he admitted this. This is an avowed statement, and I'll paraphrase. Low interest rates are no longer an option. They are now mandatory. So the BS that we heard back in 2016 through 2018, that the Fed was going to normalize interest rates, that's gone. They're not even pretending that they're ever going to raise interest rates. And the reason why they can't pretend, and the same reason why the Fed can't raise rates is the same reason why China has to keep servicing its debt through the People's Bank of China, printing money, is because the level of debt has become so onerous that if interest rates were ever allowed to normalize, we would all be insolvent as a globe. That's a fact. That's not my opinion. That is a fact. Think about what would happen to the Chinese economy and to the U.S. economy. Let's just take real estate, for example. What do you think the real estate market would do if we had a mortgage rate of 8% instead of 3%? And 8% isn't a historically high rate on a 30-year fixed mortgage. What do you think the stock market would do if the 10-year note went from 1.5% back to where it's normally traded at, which is 7%? What does that do to their valuation models if we ever normalize interest rates? So the answer to the question, who is going to service this debt? It's the People's Bank of China. It's the Federal Reserve. It's the ECB. And here's what I truly don't understand.
But then, just before you go on, don't understand. I'm going to bring it back. You don't understand. Isn't that going to be hyperinflationary?
Well, that's exactly where I was going.
Okay, go ahead.
Exactly where I was going.
Go ahead.
Here's what I don't understand. What is inflation? Well, let's see. If you ask a central banker, inflation is when too many people are working and making a lot of money and asking for a pay raise. Okay, that's bunk. Okay, that's not inflation. Inflation is when the market assumes that the purchasing power of your currency is going to be depreciated. And that usually comes from an increase in the supply. And we've already increased the supply of currencies massively. The Fed's balance sheet is back to 4.2 trillion. But a lot of that money is sequestered in the Fed's balance sheet. It's sequestered there. Here's what I don't understand. If they keep on printing all of this money, and clearly Jerome Powell said, he told you, we are going to print money and never let interest rates rise. And if the next recession appears, we are going to aggressively go back into QE. That's a quote. Aggressively go back into quantitative easing. And so here's the question I don't understand. How much longer can the market still deem fiat currencies to hold their purchasing power? Eventually, Greg, that bubble, the faith in the purchasing power of all fiat currencies is going to explode. And that's when you see gold become untethered. It was $1,900 an ounce at 2011, 2012 timeframe. It came down back to 1,000 before climbing back to 1,500, almost 1,600 today. It initially collapsed because people thought, hey, deficits are coming down, and the Fed is going to unwind all of their extraordinary money printing schemes. So we really don't need to hold precious metals. Well, it's the exact opposite today. Central banks are trapped. They tried getting out of their counterfeiting schemes in 2018. It blew up in their faces. The stock market globally went into free fall in the fourth quarter of 2018. So they can't do it anymore. So now they're telling you the level of debt has become so enormous and asset bubbles have become so untethered from reality that we have no choice but to continuously and permanently print money. That is the very groundwork for shaking the faith in fiat currencies. That is coming. You have to model it to get it right, to see it and to foreshadow it and to profit from it. But that's coming. And when that happens, watch out, because then here's this. Here's a very important point for your listening audience. A central bank has proven that they can temporarily ameliorate a deflationary depression by printing money. That they've proven. But when you have massive stagflation, so when you have an outbreak of inflation at the same time that you have no growth or very little growth, and bond yields start to revolt because the market is convinced that inflation is heading higher and the purchasing power of your currency is depreciating, and bond yields are rising intractably, central banks are impotent because the only thing they can do is to print more money. And you cannot tell a market that has lost faith in currencies, and that has lost faith in the ability to service debt, that you're going to solve the problem by creating more inflation. You see what I'm talking about?
Yep.
That's coming. That's the real problem. That's going to be the real crash.
That may be knocking at the door. Gold is at 1580 something. Last time you were on, you said, "Ooh, I have it in my portfolio, but I'm looking at adding more now of gold." Mm-hmm. If you did that, I know that's proprietary stuff, but if you did that, you're up. Other people are up. Silver, I think people are going to look back at silver and go, "Oh my gosh, I could have bought silver eagles for around $20 with a commission. I should have been buying them all day long." Tell me, is the effect of this money printing at least hitting home with some people in the precious metals market? Because they're both looking pretty strong, and gold's looking like gold's looking like it's going up.
So real interest rates are falling, deficits are surging, and the dollar is going to roll over, if not against other fiat currencies, certainly against hard assets. So all those three conditions are beginning to come in place. As I see the economic data significantly weak in the United States, I will significantly increase my position to the precious metal. I've stayed at 10%, done very well with it, looking forward to increasing that position and even extending it to the miners. Before we leave, and I think we're ready, I just wanted to wrap this up, because I'm not a virologist. I'm not an expert in the coronavirus at all. Let me just read to you, because I didn't have time to prepare as much as I'd like to. I just want to read to you a couple of things, a couple of economic data points that your audience needs to know right now. Okay. GDP in the EU currency bloc rose by 0.1% in the fourth quarter of 2019 from the previous quarter. The French economy shrank by 0.1%. Italian GDP shrank by 0.3% in the quarter, and manufacturing output dropped by 1.6% in the quarter. France reported a 2.8% drop in industrial output in December. Spain posting a 1.4% decline in December. German industrial production fell for the fifth time in the last 7 months, dropping 3.5% month over month and plunging nearly 7% for all of 2019. And then Germany is the industrial heartbeat of the Eurozone. China is their biggest customer. And these are all data points that I had to just read to you. These are all data points that were occurring leading into the outbreak of this coronavirus. I'm telling you, the economic data for the next few weeks at a minimum is going to be rancid beyond belief. And I would be very cautious in thinking that the trading algorithms and the tape reading machines on Wall Street are going to ignore all of that, especially if this virus starts to spread to other nations in a more significant manner. Then it's going to be game over. Even for the junk bond market.
Wow, even if it just stays in China, which it won't. I mean, that's not what the CDC is saying. It's going to be in America, in the end of 2020 and 2021. But even if it just stays in China and China stays shut down, that's a quarter, or nearly a quarter.
21% of global GDP.
It's a fifth.
It's not 11 anymore. It's 21. It's a fifth. More than a fifth of the entire global GDP taken offline, and the biggest customer of Europe, which is already offline, which I just read to you, that was before their biggest customer went offline. Right? Think about it.
Even if the virus doesn't come to America, the profits for American and European countries are going to get creamed.
Nike, Yum Brand. I have. There's just, I can't even remember all of the companies that have already warned and say, hey, we do a significant chunk of business in China, and we're in deep doo-doo for foreseeable future, probably throughout all of 2020. and Wall Street doesn't care, because Jerome Powell said, hey, don't worry about it. If things go bad, I'm going to print a bunch of money. And you don't want to own gold?
We'll leave it there. Silver. Do you like silver too?
I like gold better than silver. I do like silver. I like it to a lesser extent because it does have a tremendous industrial component to it. I like, in this environment, pure money, pure gold.
I got it. But you wouldn't get hurt buying silver at. I mean, David Morgan says the mining costs are 14 or 15 bucks an ounce, and it's at 17 and change. There's not much downside there, is there, for silver for little people?
Yeah,
I'm a little
if,
person.
poor man's gold. If you want to take a little silver, I would not. I would not eschew ownership. I would not reject the ownership of gold. I would own a little bit of both, but I would overweight gold for sure.
Okay, that's good enough. I mean, for some people say, I'm a poor guy. What should I do? You get paid every 2 weeks? Yeah. Go out and spend $20 every 2 weeks and buy yourself a silver eagle. Every 2 weeks. At the end of the year, you'll have 100 ounces. You'll have a fifth of a monster box. Wait, no, you won't. Yeah, it's 500 ounces. Yeah, you'll have a fifth, right? 500 ounces in a monster box. You have a fifth. You have 100 ounces at the end of the year. If he still keeps going the way it is, I mean, you get anyway. Michael Pento, thank you for coming on short notice. Last prediction: is this the blackest of black swans? Is my last question.
It certainly could be, and Wall Street has never been more confident of a quick resolution to something they have absolutely no clue about. None of us do. Not even the best doctors in the world really have a great understanding of how this new virus is going to spread. So, I mean, if you're asking me where the opportunity is, you have the most overvalued, most expensive market in the history of the NYSE, in the history of U.S. stocks, which is completely ignoring a global recession in 2020, at least for the start of the year. So, I mean, the odds are in your favor that you should at least have a lot of hedges in your portfolio and an active manager that can take advantage of the action in either direction.
And you're predicting a recession, at least in first quarter of 2020.
Yeah, I predict that Japan, Singapore, Australia, Eurozone, and China is going to be in a recession, and the United States will have most likely a sub 1% GDP reading if this thing goes away very quickly. How's that? That's my optimistic view.
And if it doesn't go away very quickly?
Then we could very easily go into a global recession throughout 2020. And don't forget, here's the one thing. As these central bankers are promising you ever increasing and perpetual inflation, the Bureau of Economic Analysis said in this last GDP print that annual inflation is running at 1.5%. How about that? You talk about China purporting fiction. How is that for a piece of fiction?
Global recession if this thing keeps continuing.
Write it down.
Global recession if this doesn't get fixed soon.
Absolutely, without a doubt. We're already in one in Europe, man. And their biggest customer is offline. How could there not be?
See, this is why they will not have you on, CNBS and Fox Business and MSNBC or MSNDNC or whatever you want to call it. This is why they won't have you on, because you'll pop this little piece of truth out with some statistics and some experience and analysis as a money manager, and they're like, well, buy stocks, buy the dips. I mean, I actually heard on Fox on Thursday, hey, the market up down 200 points, and markets and everybody bought the dip.
Yeah. There's going to be the dip buyers tell you there's going to be a V-shaped recovery in the global economy and in earnings. I mean, is it prudent to believe that the S&P 500 earnings growth is going to have a V-shaped recovery in 2020? Would that be a prudent guess based upon what the prime ministers of leading global economies are telling you? I don't think so.
Michael Pento, Pento Portfolio Strategies. You also have a podcast. Don't you have a podcast on there too? Don't you charge something for it? I don't get paid. Listen, folks, I bring this up. I don't get paid. Nobody pays me for doing this, okay? I put it out because he comes on and gives his time. Tell me about your podcast and tell me about your pentoport.com website.
So I have a podcast called, not surprisingly, the Midweek Reality Check. And I go through all the numbers. I have a 40-man team that I pay for data. That gives me a lot of information you won't find readily, certainly on CNBS. as you so accurately picked them. This is great data. It's available for 5 weeks free. And then if you like what you hear, it's $49, $49.99 per year. You get not only the data that you need to know, but some analysis that you need also. And if you have around $100,000 to invest and you want to protect and even profit possibly from this eventual reconciliation of massive overvaluation of equities, then give us a call, 732-772-9500. The website is pentoport.com. My email, mpento@pentoport.com.
Thank you for coming on. I'll go ahead and put the your website up. I'll put your subscription. Is there a subscription page and it says 5 weeks free?
Midweek reality check.
Midweek reality. I'll put that up, and I'll put pentoport.com.
I'll put
pentoport.com. So if you didn't get that, I'll give you the website, pentoportagain.com, and his subscription service, which sounds like a deal to me. 5 weeks free, pretty good.
What do you have to lose? No obligation.
$50 a year. What is that? That's $1 a week.
Yeah.
I mean, okay, less than $1 a week, actually. 52 weeks. Michael Pento, thanks for coming on short notice and killing it. And basically throwing a big cold bucket of water in everybody's faces and waking them up, because this is bad, and I'm sure I'll have you on again, and you're on record. And I think it's going to be a good prediction for we're going to get a giant recession if this keeps going.
Absolutely.
All right. Thank you very much, Michael Pento, pentoport.com, Pento Portfolio Strategies. Thanks for coming on usawatchdog.com and enlightening us with your analysis and your statistics and your experience at managing money. Thank you very much for joining us.
My pleasure, as always, Greg.